The topic chosen by the researcher for this dissertation is the extent to which the risks associated with cryptocurrency investment can be reduced. The reason that this topic has been selected by the researcher is because of the ever-increasing prevalence of cryptocurrencies ever since Bitcoin was established in 2009, and the arguments around the adoption of cryptocurrencies into everyday financial transactions and their wider use in society. In addition to this, particularly within the last year, the value of Bitcoin has skyrocketed to be worth £43,555 for one Bitcoin as of April 12th. The incredible value that can be attained through this financial medium is making it impossible for individual investors as well as financial institutions to ignore the potential returns from investing in a number of cryptocurrencies. However, cryptocurrencies are an unregulated and decentralized financial instrument, meaning that no central authority can oversee and monitor the trading and pricing of the cryptocurrencies available on the market. This, therefore, has a substantial impact on the risks associated with investing in cryptocurrencies. The unregulated nature of the asset means massive price fluctuations are a very real possibility, meaning a portfolio built mostly or entirely on cryptocurrencies is extremely vulnerable to these changes, meaning a portfolio's value can be slashed massively in a single day of trading. These risks, alongside the likelihood of hacking or fraud, mean that the risks are substantial for investing in cryptocurrencies, and sometimes the rewards are not enough to outweigh the risks. Therefore, in order to combat these risks, risk management strategies become even more crucial than in other investments. Risk is a factor that is present in every investment, and when managed efficiently, can be reduced sufficiently to a point where the rewards and returns from an investment outweigh the risks. Cryptocurrencies present a new challenge to investors as a virtual asset that is not regulated, but nevertheless, the returns can be so great for people willing to take the risk, there's no doubt they will continue to be a part of financial markets from now on. In a relatively short time, there is already a large amount of literature covering the risks that are associated with cryptocurrencies, with a variety of risks from legislation to environmental considerations being identified. According to the Homeland Security Enterprise, cryptocurrencies have a lot of societal benefits that can be and are being realized by investors currently. However, the dark side of this new asset must be considered and controlled so that future investors are not seeing investments disappear if they are not aware of the risks. In addition to this, Platanakia and Urquhart introduce one of the biggest risks related to investment in cryptocurrencies, referring to the high volatility that can be seen in cryptocurrency prices due to the unregulated nature of the pricing. This publication goes on to state the difficulties that can occur if a portfolio consists of purely crypto assets and how the value of this portfolio is very vulnerable to asset price deflation. After this, the researchers looked more into literature concerned with the risk management side of the research. In a study conducted by Diacon and NU, a number of reasons for a person's heightened perceived risk of a financial asset were established and categorized into 5 main factors: distrust, dislike of adversity, dislike of volatility, poor knowledge, and regulatory failure, alluding to the reasons why investors are valuing risk management strategies more and more highly. In addition to this, Baker and Philbeck established the types of investment risks that investors can be subject to, including market risk, a company's credit risk, and inflation risk. All of these various types must be considered by individuals investing in companies, but also by institutions when assessing risks and returns. Finally, Nadirova began to introduce some strategies, in addition with Wolk, in diversification and quitting the crypto market for a period of time that can be used alongside other strategies by investors in order to reduce the risks on their portfolio so that returns can outweigh these risks. As can be seen by the diagram on the slide, the researcher has gone through a number of stages, taking into account various topics in order to develop a research question that includes contemporary topics that can be useful in wider settings. The first topic that the researcher felt was important currently is the increasing investment in various cryptocurrencies. Following some background reading, the researcher found there is a number of risks associated with cryptocurrencies, leading to the researcher including the extensive topic of risk management within the research question. Risk is a factor that must be considered and will always be present in investments, meaning that investors are always looking for the most effective ways to minimize risk so they can be outweighed by the rewards. Therefore, the researcher narrowed the topic of risk management down to risk reduction strategies. This will be very useful in order to provide recommendations for future cryptocurrency investment and allow future investors to see the ways that traditional risk management strategies can be translated into modern assets. In terms of research design, the author felt as though working under the umbrella of quantitative research best aided the ability of the researcher to draw conclusions about the level of risk associated with cryptocurrencies, as well as provide recommendations pertaining to the best course of action for strategy selection to reduce this risk. More specifically, under the quantitative research umbrella, the researcher felt that a correlational design best suited the relationship that the author wanted to investigate between cryptocurrencies and risk management strategies. According to Walker, correlational research can be defined as the investigator deliberately seeking to examine links between variables without introducing an intervention. In terms of data collection, the author will look to obtain historical data detailing the pricing of a number of cryptocurrencies from financial databases. Once these prices have been obtained, the author will look to use the figures to calculate the risk for investors getting involved in cryptocurrencies, calculating figures such as standard deviation and variance, and compare these figures to expected and realized returns of a number of cryptocurrencies. According to Quiros et al., there are a number of advantages and drawbacks to the use of the correlational method. For example, no manipulation is required, meaning that results obtained using this method are generalizable and reliable. On the other hand, while a correlational value can be obtained between variables, no direct cause and effect relationship can be inferred, meaning that this research cannot draw a direct link between the risk management strategies causing a reduction in risk for cryptocurrency investment. In terms of validity, Heel and Twycross state there are three main types of validity: content, construct, and criterion validity. The research will look to increase the content validity of the research by using a number of risk measurements in order to establish the risk that is associated with cryptocurrencies available on the market. For a timeline, the author is already in the stages of background reading around the topics that will be covered in the research, as well as starting to write a research proposal and ethics form in order to be able to start the writing of the main piece of research. Once this has been completed and approved, the author will begin on expanding the lit review that has been started in this presentation and aim to be finishing this section in the month of June. Once this has been completed, the author will begin the data collection and perform the data analysis required in order to get quantifiable risk levels as well as comparison figures for cryptocurrencies on the market. Once completed, the researcher will begin the discussion surrounding various risk management strategies and the effectiveness in reducing risk, followed by the conclusions and recommendations from the author. All the way through this process, from roughly June to August, the author will look to submit draft work when sections have been completed so that any advice can be given. Finally, the final draft of the work will be submitted by September 24th, 2021 to be marked.